This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Rush into stocks. The Dow closes above 26,000 for the first time ever, clinching the fastest 1,000-point run in history.
Big promise. Apple is making a massive investment in America with a plan to create thousands of jobs, put billions of dollars to work, and bring a lot of money back home.
Bitcoin breakdown. What goes up can come down hard. And the controversial cryptocurrency is no exception. Those stories and more tonight on Nightly Business Report for Wednesday, January 17th.
Good evening, everyone, and welcome. Apple surprises investors and promises a big investment in the U.S. More on that in just a moment. But we begin with the incredible day on Wall Street. Stocks rose and rose and rose some more. The blue chip Dow index closed above 26,000 for the first time ever, marking the fastest 1,000-point move in history. Recall, it was just on January 4th that the Dow first closed above 25,000. The rally today was broad, with all 11 sectors posting gains and all of the major indexes finishing at records. As one strategist said, there's just no reason to sell, which, come to think of it, may be a reason to sell. But not today. The Dow Jones Industrial Average climbed 322 points to 26,115. NASDAQ added 74. The S&P 500 was up a sporty 26. If you need even more evidence of the enthusiasm for equities, a new survey puts stock market optimism among professional investors at a 32-year high. Now, what happens or tends to happen when we see an acceleration like this? Mike Santoli takes a look.
Has the stock market rally begun to overshoot? There's no formal definition of a bull market overshoot. It's not the same as a market bubble, not a mere short-term sugar rush. It's a phase when stocks accelerate higher from already high levels, the public gets excited for the market, and investors extrapolate good economic news far into the future. Evidence that we might be getting there? The rally has picked up plenty more energy in 2018. The S&P 500 is up nearly 5% since the tax cut law was passed less than a month ago. That's twice as much as 2018 earnings estimates have been raised. Riskier, more cyclical stocks are pulling away from defensive sectors. Some measures of investor sentiment and market momentum are pushing record highs. Flows into stock funds in the latest week were the sixth heaviest in history. These are all signs that stocks could be overheating in the very short term as the public embraces a richly valued market newly energized by a big corporate tax cut. The market's volatility index is actually up this year, even as the Dow has gone higher, an unusual combination that suggests the market might be in for a wider two-way swings this year, even as the uptrend looks intact. If this is an overshoot, it could last a while and be pretty lucrative in the best case. The 90s bull market probably started overshooting in 1997 and doubled in 3 years before the peak, for example. The gains posted in this phase often don't fully survive an eventual bear market whenever one might hit. The good news? The market seems out of reach of the bears for now. For Nightly Business Report, I'm Mike Santoli.
Apple's stock contributed to today's rally. Shares of the largest publicly traded company turned higher midday, and the stock kept climbing after the company announced a very big investment in this country, which also happens to be Apple's largest market. Josh Lipton has the details.
Apple's CEO Tim Cook is making a $350 billion pledge to America. Over 5 years, the iPhone maker will create 20,000 new jobs. It will also build a new campus here in the U.S., which will be its third corporate campus, in addition to Cupertino and Austin. The company plans capital expenditures of $30 billion. It will increase the size of its advanced manufacturing fund from $1 billion to $5 billion, and there are reports that the company will give employees a $2,500 restricted stock bonus. Cook saying in a statement, Apple is a success story that could only have happened in America, and we are proud to build on our long history of support for the U.S. economy. Apple's announcement aligns with some of President Trump's top priorities, which include getting companies to hire more workers here in the U.S. The president's deputy press secretary responded to Cook's announcement saying, just as the president promised, making our businesses more competitive internationally is translating directly into benefits for the American American worker through increased wages, better benefits, and new jobs. For investors, a key headline was this: Apple anticipates making a tax payment of $38 billion to bring overseas cash back to the U.S. It's doing that in response to recent changes in the U.S. tax law, in which companies pay a one-time tax of 15.5% on overseas cash. The previous rate was 35%. There are some details in this report that investors don't have. Apple is not saying how much of its $252 billion held overseas it's going to be sending home, and we don't know exactly how much more hiring and investing the company is doing in addition to what their plans already were for the U.S. But analysts are already speculating about how any freed up money could be put to work. They think it could go right back to shareholders through buybacks or dividends. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Well, a number of other tech companies were on Capitol Hill today. Executives from Facebook, YouTube, Twitter were questioned by lawmakers about terrorist content on their sites. It is the latest move by government officials to increase scrutiny of big tech, a sector that's growing fast and having a greater influence on our lives. Julia Borston has more.
Facebook, YouTube, and Twitter policy chiefs defending their companies' efforts to defeat terrorism, saying they're working together and combining artificial intelligence and their growing employee ranks to prevent their platforms from being used to recruit and train terrorists. Facebook's head of global policy management saying the company will double its employees focused on safety and security to 20,000 by the end of the year. YouTube saying it's removed 160,000 terrorism-related videos since June, identifying 98% with machine learning, while Twitter says it suspends 75% of terrorist-related accounts before they tweet. But Republican John Thune pushed the executives about why terrorist videos are still online, flagging a YouTube bomb-making video used to instruct the Manchester suicide bomber, which resurfaced as recently as this month.
How is it possible for that to happen? And why aren't your hashing efforts working to keep this video off your platform permanently?
This particular video was caught by our systems. We have used it in our hash sharing database, and we are catching re-uploads of the video quickly and removing it as soon as those uploads are detected.
The questioning expanded beyond just terrorism, as senators also pressed the companies about their role enabling Russian manipulation of the election and whether they have a political agenda. The companies saying they have no agenda and they're doing everything they can to crack down on all varieties of abuse on the platforms. This as all these companies face growing scrutiny for their size and influence, and as they take steps to assuage concerns. Google yesterday announcing that every video submitted for Google Preferred Advertising must be reviewed by a person, and Mark Zuckerberg saying that fixing Facebook is his goal for the year, changing the news feed last week to prioritize personal interactions.
When they put out these products, they seem to be stuck in this bubble of imagining the best stuff that'll happen with their technologies, and usually not pausing to think about the worst stuff. And so that's why they're behind the curve.
Now, Facebook, Google, and Twitter are trying to make sure they're ahead of the curve, especially when it comes to potential manipulation of the elections coming up this fall. For Nightly Business Report, I'm Julia Borston in Los Angeles.
In a Wall Street Journal op-ed published today, chief economics commentator Greg Ip called into question whether today's tech giants are becoming too big and should be broken up. He said a handful of heavyweights dominate their respective categories. Alphabet's Google was one example, driving nearly 90% of all internet searches. But what would more regulation or a scaling down among tech giants mean for consumers? Joining us now is the author of that article, Greg Ip. Greg, it's always great to see you. Thanks for joining us.
Yeah, great to talk to you. Thanks for having me.
In reading the article, you liken the situation that we find ourselves in today with these tech giants very similar to historical precedent, which was Standard Oil and AT&T, which both dominated their respective fields.
That's right. There's important similarities and differences. The similarity, of course, is that they're both gigantic. They're both sort of technological leaders. And they both, in some sense, are gateways to critical parts of the economy, whether it's oil and telephones in the old days or whether it's the internet today. And at that gateway position gives them extreme leverage and, some would argue, monopoly profits. But there's also important differences. Google and Facebook give their stuff away for free. It's really hard to argue that they're gouging customers. And even the stuff they do sell, like Google's advertising rates, have been falling year in and year out. They're also creating new products, so you couldn't exactly argue that their innovation is falling apart. And so it creates sort of a difficult situation. If you're in the antitrust field today, it's not so much large market share or even monopoly that bothers you. It's whether they are using that position to make consumers worse off by suppressing competition. And that's where the big question is.
So you also talk about Amazon, which has a large part of online sales, but a very small part, really, when you look at it, of overall retail sales. They have a lot of e-book sales, but there are obviously printed books as well. So how would one make an antitrust case against any of these companies if, as you point out, a lot of their stuff is being given away for free? In a lot of cases, the prices are coming down, not going up, and they're not acting like monopolists.
I think that it would be very hard right now, given what we know today, to make that case, Tyler, precisely for the reasons you cite, that it's hard to prove that the fact that they're growing bigger has actually come at the expense of consumers. Amazon, as you say, offers an amazing array of stuff. The stuff, they've had such a powerful effect on low prices, they seem to be actually affecting the inflation rate. But I think if you peer into the future, this is the question. Their dominance of certain segments, we mentioned electronic books, but look at third-party merchants. If you're a small business and you want to actually sell on the internet, the fact that roughly half of shopping internet searches start within Amazon means that there's almost no point to starting your own website. You kind of feel you have to go and do it through Amazon and pay their 15% commission. That, I think, is where questions will be asked in the future. Is this good or is this bad for consumers?
Is there political appetite to take on this sort of fight, if you will, or discussion at this point in time?
There's no question that the political world has gotten a lot more treacherous for these companies. I mean, every day we're hearing about problems of how they facilitated interference with our elections, how they're fostering social media addiction, and so on and so forth. But in the antitrust field, they really look at one narrow thing, and it's basically, are consumers better off or worse off because of this behavior? They're not going to make a judgment about whether these companies are facilitating, fake news. That's not their area. And that is why, thus far, they have not restrained them. But it's not always going to be the case. And we've seen in Europe, for example, that their bar is lower. In Europe, they're much more likely to say the mere fact that the behavior of this company drove others out of business is ultimately going to be bad for consumers.
Well, keep track of it for us, Greg. We'll have you back very soon. Appreciate it.
All right.
Greg Yip with the Wall Street Journal.
To the economy now. Manufacturing output rose for the fourth straight month back in December, and that capped the strongest quarter since 2010. The sector being helped by stronger consumer spending, increased business investment, and that improving global economy. Manufacturing accounts for more than 75% of total industrial production and accounts for about 12% of the U.S. economy.
Economic activity expanded into the new year. According to the Federal Reserve's latest read on the economy, inflation rose at a modest to moderate pace at the end of 2017, while wages continued to push higher. The Fed's Beige Book, which is an anecdotal look at the economy across the country, indicated that businesses in some districts now have the ability to raise prices, which could lead to higher inflation. Separately, the Senate Banking Committee voted a second time to approve Jerome Powell to be the next chair of the central bank. The revote was necessary because the full Senate did not take up Powell's nomination last year.
With the deadline to reach a budget deal and keep the government open past Friday, the White House today threw its support behind a short-term funding bill. Senate Majority Leader Mitch McConnell said the Senate would take up such a measure as soon as it is approved by the House.
By now, it is clear that we are not yet ready to move ahead with a major agreement on long-term funding for our armed forces, nor on our immigration policy. Compromise solutions are not out of reach. But for now, Congress needs to keep the government running.
The Republican Senator Lindsey Graham said he would not vote for another stopgap bill. Graham helped craft a bipartisan immigration deal that was rejected last week.
Still ahead, a Bitcoin bloodbath. Why the once hot cryptocurrency is suddenly ice cold.
It wasn't a pretty day for some of the country's biggest banks. Goldman Sachs reported a 50% drop in bond trading revenue. That's what investors focused on, even as the bank reported better than expected earnings and profits for the fourth quarter. Shares of the Dow component fell nearly 2% on this very positive day for stocks. Bank of America, meantime, saw its revenue fall short of expectations, in part because of a drop in fixed income trading. Loan growth was up. Profits topped analysts' expectations, despite a $3 billion one-time charge related to the newly signed tax law. Shares of Bank of America were also lower fractionally in trading today.
Bitcoin prices are breaking down. After touching a peak of nearly 20,000 in December, most major exchanges today showed the cryptocurrency trading below 10,000, cutting its value in half from late last year. So what's behind this crypto crash? Seema Modi takes a look.
Bitcoin continues to fall on growing concerns that China and South Korea, two of the largest Bitcoin markets, will ban residents from trading the cryptocurrency. The latest warning came from South Korea's finance minister, who said banning cryptocurrencies is an option on the table due to concerns over tax evasion. Further regulation is not being welcomed by all. Citizens in South Korea, over 200,000 of them, have signed an online petition asking the Korean government to not limit trading as they see value in cryptocurrencies. South Korea was one of the first countries to embrace digital currencies, and it currently accounts for a significant portion of trading volume in Bitcoin. Citizens writing, "You may think you are protecting the public, but we citizens think that the government is stealing our dream." It's not just Asia that is trying to crack down on cryptocurrencies. France's finance minister says he's launching a special task force that will look into whether individuals are using cryptocurrencies for tax evasion, a topic that got attention here in the United States when the IRS ordered Coinbase, a widely used cryptocurrency trading platform, to turn in records for over 14,000 users who trade Bitcoin. Concerns over tighter regulation has sent Bitcoin sharply lower. Just today, it wiped out $30 billion in market value. And other cryptocurrencies like Ripple, Ether, and Litecoin are also under pressure.
There is a fundamental tension between Bitcoin as an unregulated, government-less, seamless means of transaction and store of value, however you want to characterize it, and the idea that it should be regulated to be more effective. So I don't know how in the end those two are bridged.
But given Bitcoin's massive 1,200% rise in 2017, some Bitcoin investors sees the recent drop as a healthy correction. For Nightly Business Report, I'm Seema Modi.
All right, let's take a closer look now at what might have contributed to Bitcoin's collapse today. Joining us to talk about that is Matthew Green. He rejoins us. He's a cryptocurrency expert and assistant professor at Johns Hopkins Information Security Institute. Matthew, welcome. Good to have you back again. In simple terms, what do you think happened today?
It's hard to say. Cryptocurrencies go up and cryptocurrencies go down. Sometimes people try to ascribe reasons to that, but it's not always clear that there are reasons. There was definitely some fear about regulatory actions overseas. There is some indication that futures contracts may have played a role, and maybe people just panicked. Hard to know. You know, you liken it to gambling, correct? Because of the volatility that we are seeing in this particular cryptocurrency. It's a cautionary tale for investors if you just look at the chart action in today's trading session. So some people like that aspect of Bitcoin and cryptocurrencies. They like the fact that it moves up and down very quickly. But yeah, I think for people who have invested money that they can't afford to lose, cryptocurrencies are very dangerous, and it's a little worrying to me that we see so many of that kind of investor now getting involved in this field. Another person I was speaking to earlier today likened the cryptocurrencies to some of the internet stocks circa 1998, 1999. You didn't know how they were going to perform. Even Amazon, this person pointed out, lost 95% of its value at one point in its history. How do you react to that analogy, number one? And will there come a time when Bitcoin or these other cryptocurrencies aren't as prone to these spasms of moves up or down? So I think something that's happened over the last year, aside from this incredible price increase, is that we've seen a lot more money come into this field. And that's what's responsible for some of the price increase. But I think over time, as the markets become more liquid and more developed, you're probably going to see prices start to come to a point where they're actually stable and maybe not so crazy. And also, you're going to see technological advancements in the currencies themselves that hopefully will make them more useful for real applications like payments, kind of the way the dot-com bubble popped and then ultimately resulted in real tech companies we now are relying on.
As you mentioned, more people have begun to mine Bitcoin and the other cryptocurrencies. But as you look further out, do you envision a time when there is widespread adoption of Bitcoin as a either legitimate currency? I mean, it's not backed by any particular government, but a more legitimate trading vehicle.
So it may not be Bitcoin, it may be one of the other currencies like Ethereum or another currency, but yes, I do. I used to be very skeptical about this, but I think that it's very unlikely that cryptocurrencies will go away. Maybe they'll go down by 90% for a while, but I think they're here to stay.
Matthew, thank you very much. We'll have you back. I know we're going to be talking about this more. Matthew Green is with Johns Hopkins Information Security Institute.
Tiffany has a shiny new outlook, and that's where we begin tonight's Market Focus. Following a solid holiday shopping season, the luxury jeweler raised its fiscal 2017 earnings forecast and said it would invest in technology, marketing, and store presentation. In the latest quarter, the company said fine jewelry and items from its new home and accessories collection appealed to customers. The company's stores in Europe and the Asia-Pacific region did particularly well. So did the shares. They were up 1% to $108.99. Viacom's chairwoman Shari Redstone is reportedly pushing for a board shakeup at CBS. The Wall Street Journal says Redstone wants to bring on new directors as she renews discussions about a potential merger between the two companies. The report added that CBS has reservations about a tie-up. Viacom shares were up nearly 2% to $31.96. Shares of CBS were off almost 1% to $58.90. U.S. Bancorp reported earnings that rose and beat expectations. The nation's largest regional bank said the majority of its savings from the new tax law will be returned to shareholders in the form of dividends and stock buybacks. The rest will be put towards investments in technology and higher entry-level wages. Shares closed down more than 1% to $56.34.
Charles Schwab posted profits that were in line with expectations, despite saying earnings took an immediate hit from the new tax changes. Revenue topped forecasts. Schwab shares up 1%, $56.09, the close there. The drug maker Celgene reportedly in talks to buy the biotech Juno Therapeutics. Wall Street Journal says a deal between the two companies could help strengthen Celgene's portfolio of blood cancer drugs. Shares of Celgene fell more than 2% to end the day at $102.02. Meanwhile, Juno Therapeutics up 51%, sounds like Bitcoin, to $69.25. Not today. And after the bell, Alcoa posted a larger than expected quarterly loss. Revenue did improve, but that also came up short. Shares were initially pressured in the after-hours session, but they closed the regular day up 1% at $56.99. Coming up, is the long run of record low mortgage rates about to come to an end?
Walmart is wading into the opioid crisis. The world's largest retailer is distributing the first of its kind opioid disposal product. That product is called Dispose RX and includes a packet that, when mixed with water in the prescription bottle, turns the pills into a biodegradable gel that can be thrown in the garbage. The product is meant to be used by customers who no longer need their prescription painkillers, or they're concerned that someone else might take their pills.
Well, home builder sentiment is cooling off a bit, but still remains near historic highs. This as the industry deals with higher construction costs and a shortage of workers. That said, many builders are optimistic that a solid job market, rising consumer confidence, and relatively low mortgage rates will help propel housing demand in the coming months.
And even as mortgage rates stay near historically low levels, they are moving a bit higher, and prospective homebuyers are keenly aware. Diana Olick explains.
Mortgage applications rose last week, which doesn't make a whole lot of sense because interest rates also rose. Usually applications fall on higher rates, especially refinances. It makes more sense, though, when you factor in fear. Borrowers may have jumped in, worried that the long run of record low rates is over. So applications to refinance led the charge, rising 4% for the week. Refinances are highly sensitive to even small moves in interest rates, and interest rates rose to their highest level since March of last year. The average contract rate for 30-year fixed jumped from 4.23% to 4.33%. That's pretty big. We haven't seen a move like that in a while, and rates edged higher this week as well. While borrowers may be worried, expert economy watchers are not.
It doesn't appear as though rates are going to have a significant runaway on the upside, which I think should be supportive for housing purchases.
Mortgage applications to purchase a home, which are less rate sensitive, rose 3% for the week and were 7% higher than the same week 1 year ago. Home buyers may be trying to get a jump on the spring market given how competitive the market's been. The supply of homes for sale is still very low, but there are generally fewer shoppers out this time of year. For Nightly Business Report, I'm Diana Olick in Washington.
And before we go, here's another look at the very happy rally on Wall Street today and the Dow's first close above 26,000. The blue chip index climbed 322 points. There was no give back today. The Nasdaq added 74 and the S&P 500 was up 26. All of the index closed at records.
Once again.
Once
Seems
again.
like we're saying that a lot.
Saying it all the time.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody. We'll see you back here tomorrow.